Welcome to CurrencyCast. Adidas and On Holdings. How do currencies impact the business model of two very different European sportswear companies? And is it possible to thrive in the context of a strong currency? Welcome to CurrencyCast. My name is Austin McKinley. I'm the senior financial writer at Cantox and your host. In this episode, we discuss the foreign exchange related challenges and opportunities of a well-established player and its smaller and younger competitor. Now, let's start with Adidas. We know that the company outsources 100% of its production to what is called manufacturing partners that are located mostly in Vietnam, in Indonesia, in China, and to some extent in Turkey. Why does the company do that? Well, it's a way to reduce what is called operational leverage, namely the proportion of fixed costs to total costs. In 2023, and with the expectation that it would go on in 2024, Adidas discussed with investors unfavorable currency developments. What are these unfavorable currency developments? Well, they occur both on the contracting side and on the revenue side. On the contracting side, because although those manufacturing partners are located in Vietnam, in Indonesia, and in China, they are paid in US dollars, and that means that there is a large exposure for Adidas to the US dollar. There's also an announced billion euros revenue shortfall, presumably on account of the weak Japanese yen and South Korean won against the euro in recent months. So there you have it. There are unfavorable developments for Adidas expected to continue well into this year, both on the contracting side and on the revenue side. And they are the result of what Adidas itself calls its multi-currency cash flows. Adidas applies a centralized approach to foreign exchange risk management. It does so to remove costs, to reduce risks, to avoid siloed currency management, and perhaps above all, to maximize exposure netting. But what does a centralized approach to foreign exchange risk management mean? I think there are two defining features. Number one, headquarters sets FX policy for the entire group. And number two, headquarters is the only responsible for the execution of external FX trades with banks. Now, granted, there is room for some flexibility, and we know that this is the case of Adidas. Let me give you an example. Subsidiary A might find that headquarters is the best bank in the world. Why? Because with the help of FX automation, headquarters could grant liquidity to subsidiary A on a 24/7 basis. Granted, it would include perhaps a markup based on the tenor, on the timing, on the currency pair, on the size of the transaction. But still, it would be a great advantage. Now, say that subsidiary A tells headquarters that in a special case, for example, the euro to the Brazilian real exchange rate, it could achieve better terms on its own compared to headquarters. And in that case, there is room for flexibility, and we know that this is the case of Adidas. Adidas recently announced a 100 million euro shortfall on account of the dramatic fall in the Argentinian peso. While that announcement was made, rival firm Puma also admitted that its quarterly performance had been devastated by the collapse in the Argentinian peso. Now, this is a special situation. There are no hedging instruments of any sort for this particular currency. Yet there is a lesson here for currency managers. Time and again, currency managers tell us that they neglect minor currencies on purpose because manual execution would be too time-consuming and too resource-intensive a process. And that's where currency management automation comes to the rescue. because it provides a way to manage all your currency exposure, be that in major currencies or in minor currencies. How does Adidas manage counterparty risk with its banks? Well, it uses CDS or credit default swaps as an instrument. A CDS or a credit default swap is a bilateral contract between a protection buyer and a protection seller. What does the protection buyer seek protection against? Well, against the risk of a credit event or a default. So the price of that CDS or the spread provides market-based information about the perceived creditworthiness of a particular issuer of debt. So how does it work in practice? Subsidiaries normally are only allowed to execute external trades with banks if they are rated BBB plus or more. Below BBB minus is considered a speculative grade. Now, in the event that there is the need for a transaction with a bank that is rated below BBB plus, the management team, the treasury team, will take a look at the credit default swap of that particular issue. We're not told at which level it would be considered dangerous, but still, what we know is that the CDS market is used as a price discovery mechanism by the treasury team and not as an investment or trading vehicle. Founded in 2010 by 3 Swiss entrepreneurs and backed by tennis superstar Roger Federer, On Holdings is emerging as a major player in a market dominated by brands such as Adidas, Nike, Puma, New Balance, ASICS, and others. It has recently reached the 2 billion Swiss franc mark in net sales over the last 12 months, and it has 60% gross margins. Some analysts think that gross margins could go a lot higher thanks to recent innovations. So let's dig a little bit deeper and see what role, if any, do currencies play in that amazing story. Look at this shoe. It retails at about 175 euros. When you hold a Adidas or Nike shoe, one of the first things you notice is that it says manufactured in Vietnam or in China. But look at this On Holdings shoe. What you notice is a tiny Swiss flag and the description Swiss engineering. And it does have an impact. Let me explain. First, there is the cushioning technology, which makes these shoes a pleasure to wear. And this might have implications in financial terms, because if you're inclined to use them all the time, as I am personally, well, you would buy them whether the economy does well or whether the economy is in recession. And that lowers the beta in your cost of capital calculations. But there is an even more powerful technology developed by On Holdings. It's called light spray. It allows, or it will allow at some point, the manufacturing to take place in a matter of minutes, right at the retail store. Now, the company tells us that with that technology, the number of elements used, of materials used, goes down from 37 to 7, 37 in traditional shoemaking, 7 materials with the light spray technology. It would have a lower carbon footprint, and crucially, there's a timing issue. While it takes months for Adidas or Nike to arrive at a prototype, this could be achieved in a matter of minutes with light spray technology. But there is an even more important point from the financial perspective, and it has to do with the inventory to sales ratio. When you're in manufacturing and you produce real goods, you know that you need inventory if you want to sell the product. But that creates the risk of unwanted inventory, and it has to be marked down with potential impacts in terms of cash flow generation. Note that this is a problem for Adidas, but it would be less of a problem if the use of light spray technology allows for manufacturing to take place right at the store in a matter of minutes. So taking down the inventory to sales ratio is a sign of a strong financial performance. All of this is fine, but what about currencies? On Holdings says very little about currencies. The treasury team takes a constant currency basis to assess the performance of net sales. It also makes a mention to the recent strength of the Swiss franc, which is interesting considering the fact that production currently takes place mostly in Vietnam. So here's my hypothesis. On Holdings has a low sensitivity to FX. At Cantox, we developed the concept of FX sensitivity. We say that a business is sensitive to currencies or to FX if it has low profit margins and a high proportion of FX in its business, be it on the cost side or on the revenue side. Now, On Holdings has currently 60% so gross margins. And according to some analysts, if the use of light spray technology is more widespread, those margins could go a lot higher. So here's the point. On Holdings is way less sensitive to FX than Adidas. When discussing the strong Swiss franc in terms of corporate performance, what usually comes to mind is not a pretty picture. In a recent episode of CurrencyCast, we discussed the case of Swiss watchmaker Swatch, which, according to Bloomberg, suffered in 2023 a 550 million Swiss franc revenue shortfall on account of the strong Swiss franc. And then there's the matter of the deep forward discount of many currencies against the Swiss franc. If you're going to sell Brazilian reals forward or Mexican peso forward against the Swiss franc, you need to face a deep forward discount. In other words, a high cost of hedging. Now, here's the paradox about On Holdings. It's actually able to take advantage of the strong Swiss franc. Now, the Swiss franc is arguably the strongest currency in the world, and it's not just a cyclical phenomenon. For example, the Argentinian peso is currently pretty strong, but it's not obviously a structurally strong currency like the Swiss franc. And that is due to the universal confidence in the performance of contracts, thanks to things like judicial independence and an independent central bank, a little bit like the Singapore dollar. And what happens when you have a structurally strong currency like the Swiss franc? Well, the good news is that the cost of capital will be low. Interest rates will be low. They are currently at about 1.25% in Swiss franc. Now let's go back to the inventory to sales ratio. We know that this is a major problem for Adidas and to some extent for Nike as well. And consider the fact that interest rates are pretty high in dollars and in euros, especially compared to Swiss franc interest rates. That's how On Holdings takes advantage of the low cost of capital. It allows the company to invest in groundbreaking technology. Now, at some point there will be the need surely for more active currency management. So for example, the company could announce or implement a layered hedging program for its exposure on the cost side to perhaps directly the Vietnamese dong. We know that there are discounts already in terms of pricing. This is a competitive market, and a layered hedging program would allow the company to keep prices steady for as long as possible. Also, there could be the need for centralizing FX management, so allowing the company to maximize exposure netting. The purpose of this podcast is not to compare Adidas and On Holdings. The two are not really comparable companies. Why? Because they find themselves at a different phase of their own corporate life cycle, to take the terminology of Professor Damodaran. While Adidas finds itself in the mature growth phase of its corporate life cycle, quite obviously On Holdings is at a young growth phase of its own corporate life cycle. Now that has implications in terms of the finance team because different parameters will be taken into account when making investment decisions, financing decisions, and dividend decisions. Rather, we want to illustrate two things. Number one, that it is possible to thrive in the context of a strong currency, provided that management, and especially the finance team, is able to take advantage of the corresponding low cost of capital. And number two, there are lessons in terms of corporate storytelling. We know, for example, that Adidas has a brand narrative around each of its products. That's a good thing to do, as corporate storytelling is emerging as a major issue in modern management. Now, let me give you an example. At Cantox, we have developed many stories based on real situations around what we call the benefits of embracing currencies. So, for example, instead of paying its manufacturing partners in US dollars, Adidas could use directly the yuan, the Chinese yuan, the Vietnamese dong, and the Indonesian rupiah with the help of automated solutions, as both parties would gain. The manufacturing suppliers would not need to manage the corresponding FX risk, and Adidas would see a boost in terms of its profit margins because FX markups would instantly vanish. So what makes a good corporate storytelling? It's not about stories that are thread-based, that have a beginning, a middle, and an end. Rather, it's about opportunity-based, open-ended narratives that have no end in sight.